bond sinking fund. So that'll be a new account for you. All right, let's look at it. When the bond matures, it's time to get it off the books, of course, and pay for it, right? Pay off the cash. Well, what do? We take it off the books, right? Just like an accounts payable or a notes payable, it's just the bonds payable. So you're going to debit your bonds payable and credit your cash because we're paying that cash amount. So no questions there, no problem there, right? Handled the same way. The sinking fund is a fund established to accumulate the assets to pay off the bonds when they come due. So as we're going through here, we're not going to wait till it comes due and then go, oh my gosh, we don't have $1 million to pay it, right? We're going to start putting money in there.
Like a savings.
Yes. Like a Christmas fund, right? You're going to start putting money in it.
We used to do it. We had what you call a Christmas mill.
Christmas club, Christmas
Well, we
club.
had a Christmas mill. They take, in Cottonville, they take the plow off the middle,
Really?
and everything on one side goes to cheese. I mean, that's just what.
Yeah.
The profit, and on this side, that's what they wait for all the. That's what's Christmas.
So you just saw
We had a
that?
Christmas mill.
Go ahead. I like that. Okay. Right? You're going to start putting it in this investment fund. Guess what you're going to do with that? Go ahead. Investment fund. Guess what you're going to do with that? Go ahead. It's an account. Bond sinking fund investment. Yeah, it's got to be a. It'll be like a debit, like a asset till you get ready to have to. It's like sticking it in cash. I mean, we're letting everybody know we're putting it in here for.
I'm saying it's not a cash account.
It's just on. Yeah. I'm not sure if in chapter. Did they give us a new chart of accounts for corporations in chapter 20? I don't remember if we did or not. Did they or did they not?
No.
To show you some of these that we were going to be. I don't know. I don't think they did. We can look up and see. Look in your index and see if they did. Yeah. Okay. Well, let's keep going. Then we'll look. I'll look and see. Okay. So we're going to start putting money into that to cover when it's going to come due, right? Now, going back, and I didn't mention this, but this bond sinking fund investment is kind of like what the bank does with your money when you put money in a savings account. What do they do with it? They just let it sit there? They invest it. So this money, even though it's listed as being in this account, it's going to be invested to try to draw interest. Since we got to have it sitting there and we're waiting anyway, we're going to invest it. So whatever
For all it's worth.
everything is worth. So when we get money, make money on it at the end of the year, we get paid interest on what we have invested. It goes right on into that fund to help increase that fund that we're accumulating. And then you're going to have another little income thing down there at the bottom of your statement showing income from the sinking fund investment. Other income. Okay? Because this is not operating income, this is other. Okay. And second annual installment. So first installment was for $30,000 that we put in there, but the second one, since we earned interest, right, on the first one, it lessens the amount we have to put in there for the second year. So we put in the installment, take out what interest we earned on that for the last year. Now we can put a little bit. It reduces the amount we have to take out of our cash and put in there because we earned some interest. Yay. Okay, and we keep doing that every year. And whatever we earned the year before, it reduces down what we need to put in for that year. Bonds retired at maturity, 10% bonds. And what we do is we've already got the money sitting in that investment account now. So all we have to do is say, okay, pay the bonds payable, right? Take it out of the sinking fund. It was just sitting there waiting to be paid. Okay. I think that's the only thing. I just wanted you to be familiar with it. We can set it up two ways. We need to be
So what
having
do you
money.
do with the interest that's, like, say your bond was $150,000, say you made, after interest and everything, say you made $180,000.
I just covered that. Go back.
Did I miss that?
You missed it.
So you wouldn't put as much, you just put enough in, okay, okay.
Yeah.
I didn't
So what
miss
you're
that.
doing is you're going to recognize that. See, as we get that
I
interest,
just never made that.
you didn't get the connection. I knew that. That's why I went back. No, but you're thinking right because it would have had a bunch of interest.
Because, I mean, I was thinking.
But what we're doing is we're going to recognize that as income each year, and go ahead and take that income and put it in the sinking fund.
Yeah.
So it
Well,
reduces the amount.
It just knocks it off.
Right.
From what you had to put in
And the next year we can take that amount off. Right.
And then the
Yeah.
next one, on like that. Till you
But
get out
each year we're going to recognize that as other income. That's what's happening to the
Right.
interest. Okay.
Right.
Yes. So, okay. Record an increase or decrease in the retained earnings appropriated for bond retirement. What happens is, when we get ready to put out a bond, decides to appropriate $30,000 of retained earnings during each of the 5 years that the bonds are outstanding. What we do is we record that as appropriated funds from retained earnings. So, yes, we do have we take it out of retained earnings, and then under our retained earnings, we're putting retained earnings that are appropriated or set aside to pay off that bond. Okay? That's how they decide to do it. They do, yeah. There should be one of each example of each group. Okay. Yeah, there should be one showing you if they set up a sinking fund or if they just allocate it out of their retained earnings and set it aside that way. So then that way, each year, at the end then, it would be sitting there in retained earnings. So then at the end of the year, we'd take that, we'd have it, the appropriation here. Debit the appropriated amount, credit the retained earnings, put it back in, because we paid it out of cash and paid it out of our sinking fund. But we had to know that much of our retained earnings we couldn't use on anything else during that time.
So it's kind of like a reimbursement from paying out.
You're just showing that it's no longer set aside. We've taken care of it and paid it, so now it can go back in our retained earnings. Okay. We did that.
And there is a loss too, if you retire early.
If you retire 'em early, you'd have to come up with the money. But it's not going to happen, hopefully, because it would cost us less. It would cost us less maybe what we owed on it, depending on the amount of interest. But probably not going to happen. Okay, these bonds were sold 3 years after the expiration date. The discount. So retirement of your bonds. The interest is paid on October 1 and April 1 of each year. The bonds were issued at $97.97 apiece. The discount, remember when we said if we sell something below the value that we're going to have to pay or get, then it ends up as a discount. If we sold it for more than what we thought we were going to get, it would be a premium. And same way. Same as you're looking at it the same way you look at your stock. Okay. And then we amortize our discount the same way. It's going to be handled that same way. If you look back on how we handle the premium or the discount on the stock, it's handled the same way. We should have surplus cash in case we do have to, because the interest rate decreases could result if we got our interest in and decrease the amount we owed by putting it in that sinking fund. We might be able to pay it off early. Okay. In your 6 months period, if we had to discount it by 1,120, you just divide by all your months and come up how much you've got to amortize per month. Okay. It's not really we had, in whatever we had outstanding, the bonds were issued at a discount, so we got 50% outstanding retirement. We're retiring at $101 plus accrued interest, so we have to pull everything out. Whoops. What is the amount of the unamortized discount at the time of retirement? Gonna get your balance in there, see what you've amortized. Gonna come up with a balance left on the discount, in the discount account. So as you're posting, you're gonna come up with what's left in there. I doubt that y'all have to do it. You might have to. Then the book value, take out the discount. And when we retire them, we have to pay $49,040. So wherever we are in that place, if we do retire them, we take out the discount, and that's what we owe. This will just be, we'll just have to follow it step by step too. And again, we record our interest up to date, just like we did, remember when we retired equipment or something? Record our interest and take our get interest up to date, whereas we had to get depreciation on our equipment. Y'all good? Okay. And when you bring it up to date, then we know how much bond interest we had, what the expense should be, what the payable is, and pay it out in cash. And okay. What are we doing here? I didn't read the directions. Bond, interest, expense up to the date over retirement. And gain or loss is the difference between book value retired and what we paid for them. So the repurchase price value when we have to pay for them is going to be, how do we get the 101? Oh, that's the cash payment. Okay. All right. So then here we go. Repurchase price, face value, answer, then you got to pay the cash, which would be your face value times what you've agreed or what the repurchase price is on that date when you repurchased them. Okay. If you had a loss, because the book value, we had a gain or loss, the book value was $49,040, but we had to pay out $50,050, so we had a loss on the early retirement. Because we didn't have time to accumulate enough interest to help offset our discount. Okay. Then you show your bonds payable, your loss, how much cash you had to pay out, and then the other thing would be your closing after discount. Okay. And that's about it. So let's go ahead, and when you get to that part, we'll just have to come back to this page and look it up. As you're thinking through these, though, as we're doing them, you're going to, let's see where we are. Okay, so everybody's got there, the first thing you want to do is open your accounts, and I think they're already open for you, aren't they? You got the beginning balance in them already? Yay. That works. Yeah. Then, start analyzing your transactions, and then when you finish, you're going to post them to the general ledger. Prepare your worksheet, income statement, retained earnings statement, balance sheet, and do your adjusting and closing entries. Same process. Okay? And so let's focus on your entries right now. Transactions. So we don't have that many transactions, do we? So let's think through them, do them one at a time and talk them out. Be sure everybody's on the same, got the same answer. So you've only got that much to do. And then on the next page, you've got to do your summary. The summary on the next page gives you all that information about what was going on in the operation of the business.